Hi, everybody. I'm Alicia with EasyStreet Realty, and I have a virtual meeting here with our in-house lender who is going to go over some of the lending changes that we've seen in the market.
All right, Alicia. So, a lot of changes. Let's start with that. Biggest changes are a few things. Most people don't utilize what we call our non-QM loans. Non-QM loans, a lot of times, are for self-employed borrowers, people who can't prove income. And what they're doing is they're using bank statement programs, stated products, things like that. That entire market has stepped to the sideline. So those borrowers, they got to wait. The jumbo market. Out here, our jumbo market starts at $510,400. Anything over that amount goes into a jumbo product. We used to be able to do 5, 10, 15% down and have, decent rates. Again, on a jumbo product with small down payment, you're going to pay, but we had them. Jumbo market, we have nothing under 20% down payment anymore. Rates also have moved up a little bit on those products too than from where they were. A lot of them have a cost now, where before we could do them at no cost. Now they've got a cost. Conventional, FHA, and VA. Those are typically the three that we use the most. FHA has most of the changes. FHA, I think when you and I spoke last Monday, we could actually still do an FHA loan with a 640 credit score. The week before that, prior to that, we could do a 580. We could go down to that low FICO borrower, and to be honest with you, even at a 580, they were still getting rates in like the mid to low 4% range. It was crazy, right? Then it went right up to a 640, and I kind of was frustrated, but that's what's happening in the industry. And on Friday, we got the notification. Now we're at a 680. What happens is a lot of this is not FHA making these changes. These are investors. All the banks that are buying these products, they're the ones that are they're called overlays, because they're too terrified right now. So they only want to work with the best of the best, right? They want that 680 credit score. They want 6 months at least in the job. They want to see that there's some stability. That has really created a big change. It really has, because especially out here, we have a lot of those borrowers under at 680. We deal with them on a daily basis. Biggest change really has happened is in pricing or interest rates. I left on vacation March 5th. Rates were awesome. I came back March 9th on a Sunday night, and on Tuesday at our meeting, the entire market had turned upside down. And what happened with that is that the certainty is not good for the mortgage market, not at all. And what's happened now is a lot of, we call them servicing companies. Servicing companies are those companies that you make your monthly mortgage payment to, right? Those companies, they buy the servicing right when we sell a loan. What's happening right now is they're not buying them, or they're charging us to take those. And what's happening is, because of that, we're having to increase rates to cover that. And by increasing rates, I mean rates literally almost overnight went up 1 to 1.5%. That really changes someone's qualifying numbers. If you're buying 300,000 and you're kind of at your top number, and we're at 3.5, and now you're at 475, you can't buy that house anymore. So what's happening is, what we're really hoping for is that the feds get involved here and they help servicers, because what people don't understand is we're having the term forbearance right now. Forbearance means, hey, go ahead and take a couple months off your payment. We know, you're in trouble, and let's do that. The problem is, as you and I were discussing earlier, on a forbearance, they're going to give you a couple months off. But when that forbearance term is up, you've got to make all those payments up at one time. Well, if you couldn't make one house payment, how are you making four? So what's happened is, the servicing companies, when the consumer pays their payment every month, that servicing company still has to pay the investor. They still have to pass that money through. Well, if they're not getting it, what are they doing? They're having to pay with their own dollars. Well, they can only do that for so long. And if they can only do that for so long, they don't want to buy servicing rights to loans, because they're afraid people are going to be missing payment. I have clients right now that bought a home last month. Wonderful, wonderful lady, worked her buns off for 4.5 months while she was having her new build, saved I think it was a little over $30,000 working 2 jobs, just an opportunity of a lifetime for her, in her late 50s, her first home, and she lost both of her jobs. She works in the hotel industry. She's calling me, how do I miss a payment? I feel horrible for her, but if you miss a payment, now we start getting in trouble. So those are the kind of things that are really happening, and a lot of the public doesn't understand, what's happening in that back end. And that back end is really creating a problem. Now, the feds are going to get involved. They know that they can't leave the servicers hanging out there. So if they can get in there and start guaranteeing that they're going to get their monies, then servicing will come back and buy loans, which when they do that, it's going to drop our interest rates again. And that's really what we need. We know that the activity is not nearly as much as it was, but again, there are still people that are buying. And the difference between a 3.5% and a 5% rate is tremendous. I think today you and I had a conversation earlier, and I did a $300,000 purchase with a person with a 760 plus credit score, right? So a solid credit score. Basically, that payment right now is at about a 4.5% cost, 4.5% rate. I'm sorry. Right now, you can buy that rate down with 0.5%, less, just over half a point, very small amount. And that gets you all the way down to a 3.375% rate. Well, let me tell you, that is a monster difference. That's a few $100s a month difference in payment. And so that's kind of what's happening right now. I do believe it's going to come back. I do believe we are going to deal with a little bit of pain right now, but I'm always the optimist. I am. I wear rose-colored glasses when I wake up in the morning, and that's the way I get through life. But they're a little more foggy right now. Let's say that. I'm a little more hesitant, but in general, I do believe it's going to come back, and we're all going to. I think there'll be a boom. The in the third, maybe fourth quarter, there's going to be a lot of pent-up demand, and we see inventory growing again. There's going to be a lot of people that want to buy, and I'm optimistic about maybe more how we end the year than this immediate future.
Got it. So just to recap quickly, some what you said, some of the points you just made, you're saying that right now we're looking at, if we have an FHA buyer, they need at least a 680 credit score to qualify, and that up to about 2 to 3 weeks ago, we could have went down all the way to 580.
We're down to 580. Now, for full disclosure, those are overlays because FHA will still go down that low. What's happened is most of the investors just don't have an appetite for these types of products right now. So what they're doing is they're throwing on, we call them lender overlays. They're creating stricter guidelines so that they're going to take this loan. There are some lenders out there still that will go down low. I think the lowest I've heard was a 620. But again, for that, there's not a lot of them out there. There are some of them, and really make sure you're vetting that lender if you are that low FICO score borrower.
Okay. We've also discussed many times that conventional loans are very FICO score driven. And now that we're seeing that FHA, which was primarily a loan for people who didn't have such a high FICO score, is now going to need to basically improve their score by 100 points. So my question is, do you guys at Direct Mortgage Funding have somebody that you work with in particular might help people with credit repair? And do you offer any guidance on how to, for somebody to get their credit score up?
Absolutely. When I pull a credit report, I actually get my 3 credit scores. I get just below that, it shows like a potential increase. Typically, that's all tied to revolving debt. Revolving debt's credit cards. Not your car payments, nothing else, no collection accounts, just revolving debt. If I see a potential for big increase, I can go in there myself and run it through a program that we utilize. A program I can manipulate balances, paying off debts, paying them down, paying them up, leading, whatever I need to do. And it's darn near 100% accurate. So if I read something and I see a lot of, just consumer debt and it's high balances, I'm just going to show, I'm going to create some numbers and lower them. So on a $3,000 card, if I'm at 2,500, I'm going to drop it to 1,500, then 1,250, and then 1,000. And each time I drop it, if I see the scores jumping up, then I'll let the borrower know. If at some point it doesn't jump up anymore, then that's where I'm going to tell them. I'm not going to make them pay it down to 1,000 if at $1,500 I can achieve the same score. At that point, I'm going to say, Mr. Barr, you need to pay this one down to this one down to this. Medical collections, a lot of people know that or don't know, medical collections, we don't care about it. Now, they do hurt your FICO score, but we don't care. I closed a loan a couple years back with a gentleman who had no insurance and he had a heart attack. $150,000 in medical collections. We still closed that loan. So it's not that you have to pay them. A lot of people want to go pay them. I'm going to go pay this because I'm going to go buy a home. Well, the worst thing they can do is do that before they talk with us. Talk with your lender, because what we're going to do is I'm going to tell you, look, I don't care about those and they're not affecting you. Now, if I can get them deleted, there are a couple companies here in town that actually delete those if you pay them. Now, you got to pay it, but if you pay it, they'll delete it. And for an example, I had a lady who had I don't know the exact number, 620 something as a credit score. And we were doing a refi. 620 on a refi was crushing her. He had one $500 medical collection it was within 6 months. Called the collection agency with her, explained the situation, and if she pays it now, would you delete it? He said, of course. Paid him the $500 on the phone. I did what's called a rapid rescore. Her score went up 99 points.
Wow.
Well, a lady with a 620 or a 720, because she was in the mid 620s, so she went to the mid 720s. That's a night and day on interest rate and how we're going to get you qualified. So I actually, a lot of times, will do what I can do. If it's pretty intense, there's a lot of work to be done. I've got a gentleman that I've been using for years. He is awesome. Fantastic communication. I mean, literally, I send him an email and say, please take a look at this. And within 5 minutes, normally, I've got, Dave, this is what we can do. Give me the borrower's number. I'll call him right now. He picks up a phone. He gets him on the phone. He's very reasonably priced. He doesn't BS, and that's the key. That's why I've used him for so long. He tells them exactly what he can do, what he feels the time frame is, and the borrowers, now at this point, the borrower's an adult. If they want to do it and they want to go through the program, fantastic. If you choose not to, it's okay too. But yes, we definitely have options to help people get scores up.
That's awesome. So by running certain simulations, trying to target where you could pay down a few things, you're able to advise somebody on how they can get their credit score up.
Absolutely. It's typically about a 15-minute. I don't keep them on the phone for that because I always pull credit with the client. I mean, 99% of the time I pull it while we're talking because I want to go over it with them. I want to tell them what the scores are. I want to tell them what I'm seeing. I want to make sure that, they didn't just pay off that car or the credit card, they didn't just charge it up. I want to go over that information. And then what I do after that is at that point, I tell them, look, give me a day or so. I'm going to go through that credit report. I've got to go through all 3 bureaus. I've got to manipulate all the different accounts to see what's going to create the highest increase. And then at that point, they'll typically, like I said, if it's just credit card debt and they can pay it down, we pay it down. We do what's called a rapid rescore. It typically takes about a week.
Okay.
And we verify all those numbers. And I'm telling you, scores are up overnight.
Okay, so it's really interesting, especially now that their FHA buyer has to get their credit score up too. I guess one thing I'd like to note, I know that you must see this all the time. We work together a lot as we're, fielding people, new leads that come in and people who are interested in buying. A lot of times people are not ready to purchase right at that moment anyway. So I think it's great that you're able to put a plan in place where we can get somebody qualified, even if it takes 6 months, sometimes. Yeah, I mean, I think one of the things I always advise is let's talk to the lender first and see where we're at.
I've seen it take a year, Alicia. And, the one thing that I do is I never want to crush someone's dream of home ownership. Now, not everybody's ready to buy right now, right? There are issues that are happening. So the idea is I never say no. What I tell them is, look, we can't do it now. But if you're willing to do this, I'm going to show you what it takes. It could be 3 months, 6 months, 9, 12, whatever it be. You and I both know a year is gone in the blink of an eye nowadays, right?
Right.
If you could still buy a home in a year, you've got to follow a program. Hey, you know what? In a year, when we get to sit with them at that signing, you get to hand them the keys that evening, all worth it. I mean, that's what we do. And we love what we do. I love helping someone buy a home. It's the greatest experience I've ever had. Watching someone smile or get a tear at the signing because they're so excited. And that's awesome. Awesome. And I get to be part of it. And you too. I mean, we're part of this. It's a dream.
It absolutely is. Okay, so then I just want to just say to everybody then that real estate transactions are still happening here in Las Vegas, and that we are here to help you. If you have any questions, even if you're laid off right now, I know it's difficult for people to try to think ahead, but if you know that you are going to be going back to work at some point and you do have a dream of achieving homeownership here in Las Vegas, I'm going to put Dave's information in the text of this video, and I'll put my information as well. And just give us a call so we can help you put a plan in place so that when you are ready and back on your feet, we'll be able to help you achieve that goal. Thank you so
Love
much,
it.
Dave, for your time. I
Love
really
it.
appreciate it.
You got it, Alicia. Have a wonderful day.
All right, take care.
Bye-bye.